If you earn a salary in America, there is a reasonable chance you are paying a higher federal tax rate than some of the wealthiest people alive. Not because they cheated, because they followed the rules more carefully than most people ever learned to. In 2018, Elon Musk's federal income tax bill was $0. Not reduced, not minimized, zero. Jeff Bezos, zero in 2007, zero again in 2011. George Soros, 3 years in a row. These are not rumors. These figures come from actual IRS records, obtained and published by the investigative outlet ProPublica. Some of the individuals named have disputed these figures. Links to both the ProPublica report and their public responses are in the description. Here is the part that should concern every working American and anyone watching from the UK or elsewhere. None of it was illegal. Every zero was perfectly within the law. Tonight, 3 strategies, plain language, and for each one, I will show you what it looks like in your life. Here is what the data actually shows. The harder you work, the more hours you put in, the more overtime you take, the more W-2 income you generate, the higher your effective federal tax rate tends to be. Meanwhile, income that requires no labor at all, money that grows while you sleep, assets that appreciate while you are at work, is taxed at a lower rate, or in some cases, not taxed at all. Many economists and policy analysts argue that is backwards, and that debate has been public for decades. And it is completely legal. The 0% capital gains bracket is published on the IRS website. The depreciation rules are in black and white in IRS Publication 946. The strategies we are covering tonight have been written about in major newspapers for years. Many people never discuss these options with their accountant unless they specifically ask. The information was always there. What was missing was someone laying it out in plain language. That is what the next 8 minutes are. 3 strategies, all legal, all in active use today. Strategy 1, buy, borrow, die. Strategy 2, the 0% capital gains bracket. Strategy 3, real estate depreciation. Each one coming up now. One fact underlies everything you are about to hear. The IRS does not tax what you are worth. It taxes income, and it taxes earned income the hardest. Say you earn $75,000 at your job this year, taxed before it hits your account. Your neighbor has the same $75,000, but from investments held for 2 years, same amount. In some cases, completely different treatment, possibly zero. That gap is what these 3 strategies are built on. Strategy 1 is called buy, borrow, die. Yes, that is its actual name. And once you understand it, you will never look at a billionaire's lifestyle the same way again. 3 steps. Step 1, buy. You purchase assets, stocks, real estate. You hold them and let them grow. You do not sell. No sale means no taxable event. The IRS only recognizes a gain when you sell. Hold it, and those gains are invisible, completely invisible. Step 2, borrow. And this is where it gets interesting. Your investments have grown. Instead of selling, which triggers a tax bill, you use those assets as collateral for a personal loan. The bank gives you cash. You spend it. And here is what the tax code says about that cash. It is not income. Loans are not taxable. The IRS cannot touch a dollar of it. Think about what that means in real terms. Say you earn $50,000 at work this year, taxed before you see it. Your friend, same age, same city, borrowed $50,000 against stock he has never sold. You both have $50,000 in your accounts. You paid federal income tax on yours. He paid nothing. His came from a loan, not a paycheck. Same amount. 2 completely different tax realities. Step 3, the one named after death. When the owner of those assets passes away, heirs inherit everything at current market value, not what was originally paid. A lifetime of accumulated gains, never taxed while the person was alive, is legally erased at the moment of inheritance. This is called a step-up in basis. Now watch what happens. That capital gains bill, potentially billions, simply disappears. Legally, permanently. No one ever pays it. Live off borrowed money, pass on clean assets. The bill that should have existed never does. Strategy 2 is the one most working Americans have never been told about. And unlike the first, this one does not require a large asset base. The federal tax code has a long-term capital gains rate of 0%. Not reduced, not deferred. 0. federally. Here is the strange part. It is not hidden. It has been in the tax code for years, and the majority of people who qualify have never once heard it mentioned. The 2026 threshold. If you are a single filer and your total taxable income after deductions stays at or below $49,450, your federal tax rate on long-term investment gains is 0. Here is what that looks like between two people. Say you and a colleague both bring in $60,000 this year. You earn yours through your job, salary, W-2, direct deposit. Your colleague earns his through investments held for over a year. No other income. He takes the standard deduction of $16,100, bringing his taxable income to just under $44,000, well within the 0% threshold. You pay federal income tax at your ordinary rate. He pays 0 federally on $60,000. And this matters. 60,000 is not an unusual number. Millions of Americans are close to that range. The bracket is there. The door is open. Most people just never walked through it. 2 caveats, precisely stated. First, long-term only. Assets held more than 12 months. Sell earlier and you pay your ordinary rate. That 12-month mark is the line between two entirely different tax realities. Second, if your total income as a single filer exceeds $200,000, an additional 3.8% net investment income tax applies. That threshold has not moved since 2013. It does not adjust for inflation. Over time, more people cross it without the number ever changing. For viewers in the UK, your equivalent is the capital gains annual exempt amount and the basic rate band. Different structure, same principle. Investment income is taxed more favorably than earned income. We will cover the UK version in a separate report. Warren Buffett has said publicly that his secretary pays a higher effective tax rate than he does. He was not exaggerating. He was describing the architecture. Strategy 3 is real estate depreciation, possibly the most counterintuitive thing in the entire United States tax code. The IRS allows property owners to deduct the value of a building as though it is gradually wearing out, even while that building rises in value every single year. Here's the strange part. A property appreciates for a decade. The owner simultaneously reports a paper loss on it every year. Both things are true. Both are legal. That paper loss, called depreciation, reduces taxable income without a dollar leaving the investor's pocket. For residential rental property, it is spread over 27.5 years. Here is how the numbers look between two people. Say you and a friend both collect $18,000 this year. You earned yours through overtime. Your friend collected his as rent from a property worth $400,000. $300,000 is the building value. Land does not depreciate under IRS rules. The exact split varies by property and location. A tax professional determines the precise figure. Now watch what happens. The IRS allows your friend to deduct that $300,000 over 27.5 years, approximately $10,900 annually. No cash leaves his account. After that deduction, only about $7,100 of his $18,000 is taxable. You paid tax on the full $18,000. He paid tax on roughly $7,000. Same amount collected, treated very differently. One note for higher earners. Depreciation offsets rental income directly for most investors. If your adjusted gross income exceeds $100,000, passive loss limitations begin to phase in. Above $150,000, they apply fully for most W-2 earners. A CPA can walk you through structuring it correctly for your situation. The property did not lose value. It likely appreciated the entire time. The depreciation was a paper entry. The asset grew while the tax bill shrank. Over 10 years, approximately $16,000 in federal taxes legally never paid on a growing asset. That is the playbook. What you can actually use. You do not need a large portfolio to use the logic behind these strategies. 3 things available right now. First, your 401k. The majority of Americans with access to one are not contributing. 26, the limit is $24,500. Every dollar contributed is removed from your taxable income before the IRS calculates what you owe. Say you earn $70,000. Contribute the maximum, and the IRS calculates your bill on $45,500 instead. Same job, less tax, immediately. Second, hold investments for over 12 months. Selling at 11 months versus 13 months could be the difference between your ordinary income rate and 0% federal tax on that gain, assuming taxable income stays within the threshold we covered and you take the standard deduction. Same investment, same profit. The calendar is the only variable. Third, tax loss harvesting. If an investment drops, sell it, lock in the loss on paper, and use it to offset gains elsewhere. Then reinvest in something similar, but not identical, to stay in the market. One rule to follow precisely: buying a substantially identical security within 30 days before or after the sale disallows the loss entirely. That is the wash sale rule under IRC Section 1091. Done correctly, available to anyone with a brokerage account. Same rulebook, different pages. According to ProPublica's analysis of IRS data, which the agency has disputed on methodological grounds, though the underlying figures have not been refuted, the 25 wealthiest Americans saw their collective net worth grow by $401 billion between 2014 and 2018. Their combined true tax rate, 3.4%. The average middle-class family paid more, on far less. The tax code does not reward work the way it rewards ownership. A salary is taxed the moment it is earned, visibly, unavoidably, automatically. An asset that grows, is borrowed against, and passed on may never face a tax bill at all. That is not an accident. It is a choice, written into law and renewed by every Congress that had the power to change it and did not. If you have ever worked overtime and wondered why the extra hours barely showed up in your account, now you know why. The system was not broken. It was working exactly as written. The rules have not changed. Most people simply never read them. Now you have. If you want to go deeper, the Roth conversion ladder, cost segregation, or how to build the kind of income the tax code actually rewards, leave a comment below. I will cover it in the next report. UK viewers, drop a comment and I will cover your version separately.